Welcome back to Global Mantra. I'm still in conversation with Glen Finegan of First State Investments. They do not have operations in India as of now, but they're a big asset management company that works out of Edinburgh, Singapore and Hong Kong. And like I pointed out earlier, their GEM portfolio is about $10 billion. Glen, how are you approaching the emerging market space? So how are you reallocating your portfolio, if at all?
How are we working at the moment? Well, we were trying to make ourselves as defensively positioned as possible throughout 2010. What we're doing now is we're looking again at the markets like Brazil, like India, like China, where we have seen corrections, and we're looking for ideas that are approaching valuations that we think provide attractive long-term entry points. At this time, we're still really feeling that the BRIC markets are still quite fully priced, but we have been finding reasonably priced companies in some of the more peripheral markets, like I mentioned, South Africa and Taiwan, but even places like the Philippines have come back into territory where we think prices look okay.
How are you protecting your portfolio, given that there is some amount of risk aversion expected because of the Middle Eastern crisis and with the expectation on where oil would go from here?
I would say that since the global financial crisis, we've been gradually increasing our holdings in gold. We are concerned. We don't claim to be macroeconomic experts or specialists by any means, but we are concerned by the developed world's policy of printing money or quantitative easing as a route out of the problems being faced by Western economies. We think that printing money is quite an inflationary route to take, and we view holding a position in a gold miner as a way of hedging against the
So how much have you scaled up in terms of your exposure to gold over the last few years?
Our Global Emerging Markets Fund has around 6.5% in gold at the moment.
How do you see the global market situation panning out by the end of this year? I mean, we're just down the first quarter so far, but given the trends that you're observing in terms of an overall performance, where do you see developed markets and emerging markets by the time we close out this year, keeping all scenarios possible in mind?
Well, I'm going to dodge that question and remind you that our investment time horizon is 3 to 5 years. There's nobody on our team who's measured on anything shorter than 3 years. So that is genuinely the investment. When we're talking about whether or not we're buying or selling, that's absolutely the time frame that we're working on. What I can say is that the companies we've been adding to in the current bout of weakness that we've seen are companies that we believe will provide us good absolute returns on a 3 to 5 year view.
Okay. Emerging markets Asia holds about 52% in your overall GEM portfolio. What is the bifurcation there? How much does India hold? How much do the other markets? You spoke about Philippines, you spoke about Taiwan. There's also a thought on Thailand. What is the breakup like for Asia?
Sure. Well, India is about 7% of our portfolio at the moment. We don't have a lot of money invested directly in China. And again, this comes down to this idea of alignment. A very large number of the Chinese large companies are state-controlled enterprise, and again, we have this issue with the motivations of the managements and controlling shareholder, if you like, and minority shareholders. Our greatest exposure is to Taiwan, and then after that, Hong Kong. We own a number of Hong Kong corporations that are expanding into China. Hong Kong China Gas is the gas utility provider in Hong Kong, but actually sells more gas in China than it does in Hong Kong, and doesn't currently make as much profit out of China, but in the future we believe it will. So we believe that China is a growth market, but we're looking to find companies which are privately run with managements who are aligned with us.
But how are you playing the inflation risk across the region right now? Because that's a key concern.
Well, we look for companies that have very cash generative models and a level of inflation protection. So as I said earlier, we are attracted to the consumer companies, and the bias in our fund is still, even after selling some of the more expensive names, towards the consumer sectors. These are companies that tend to own brands, and brands have historically given companies pricing power, and we don't think that this will be any different this time around. It may take a quarter, a year for that pricing power to come through.
But you can't have a whole portfolio of consumer stocks. There has to be some diversification.
Absolutely.
Right? So where are you seeking that?
Outside of the consumer, we have a quite large exposure to the IT sector, and that's largely through Taiwanese corporations. Again, these are very cash generative businesses, and when I say that they are classified as IT companies, but what they really are is very large-scale manufacturing businesses. So we own TSMC, it's the largest holding in our fund. It's one of the largest semiconductor manufacturing companies in the world. We own Delta Electronics, it's the largest manufacturer of switching power supply in the world. And we own Quanta Computer, which is the largest assembler of notebook computers in the world. And the common trend there that they're all the world's largest, or one of the world's largest in what they do. And that enormous scale they have has allowed them to bring costs right down and created quite large barriers to entry in the businesses in which they operate. So we believe that these companies have very dominant franchises that will remain cash generative. So
what about infrastructure names? What about engineering, construction companies in the region?
We don't tend to have too much exposure to infrastructure. We don't particularly like to own regulated assets, because ultimately this comes back to this idea that emerging markets are emerging in the sense that they're growing faster, which is great. That's all of the good part of it. But the bad side of being an emerging market is you have an emerging legal system and an emerging political system.
We'll take a short break on that note, but when we come back, we'll talk about India in specific. First State Investments has an India subcontinent fund. Talk a little bit more about the holdings there.
Well, one of the things that stands out is that India is a popular and quite expensive market, but the telco sector not so. The valuations of Indian mobile cellular companies are reasonably attractive, particularly given the scale of the market and the size of that. If one is willing to think forward as to how big the market might be in 5 years' time, we find the presence of a free press in India to be very positive. We like the fact India is a democracy, unlike China, and we think that the sort of checks and balances that brings